Okay, let's get started. This is a series and a playlist dedicated to teaching you the basics to financial accounting. My name is Mr. Leong. I teach business in a high school and I graduated with an accounting degree with honors. So, in this series and playlist, I'm going to teach you about processing transactions, bookkeeping, different types of statements, and let's start with the basics. So, in this video, I'm going to cover what financial accounting is and basically the accounting equation. The fundamental accounting equation is assets, liabilities, and equity, but what do those exactly mean? So I'm going to record this video in one take and let's get started. Financial accounting is really important to a business, and you want to provide financial information that's timely, accurate, and relevant to the business over a period of time. Maybe you need to make some financial decisions, such as whether to buy some property or some new equipment or to change locations and maybe pay a little bit more in rent, but you're in a better location. All of that, you need to have relevant, timely information, and that's what the purpose of financial accounting is. You also need to have the proper information reported on your tax return, and there's a few stakeholders which we're going to get into that require proper, accurate books and information. Every day, maybe you have a bookkeeper or once a month that records, summarizes, and reports the business activities. Every time you buy something, you sell a product or service or an idea to a consumer, that all gets accumulated, and then depending on your reporting period, you prepare something called a financial statement. And these can be things such as a balance sheet, where it tells you how much you own, how much you owe, and your net worth at a specific point in time. You can have the income statement, which is basically a summary of the profits you made over a specific period of time. You can have a statement of retained earnings, which dictates your net worth and the dividends paid out. And you can also have the cash flow statement. And the cash flow statement tells you how much money you started with at the beginning of the year, how much you ended with, and the different types of activities that resulted either in an increase or decrease in cash over the year. This information is usually provided to some sort of external users for the company, so investors, the bank, and government, and also sometimes some internal users. I think a good example of somebody who needs financial information is the bank, because maybe they're trying to lend you some money, but they need some sort of document that really illustrates how the company is doing, whether it's profitable, how much money they have, and also how much money they owe to other entities. So financial accounting is really important because it provides detailed, timely, accurate, and relevant information to the variety of stakeholders for a business. Publicly traded companies also need to report their financial statements. Sometimes you're going to see like the Form 10K basically reported to the shareholders, and you can easily access them on the internet. Okay, so we have the accounting equation. These are my own personal notes. And basically, if you want to calculate how much the company is worth, you use this equation. Basically, your assets, what you own, equals what you owe to other individuals or entities. And then this is your equity or net worth. So let's start with things that you own, and you can rearrange this equation. So if I also wanted to, I could do assets, which is equal to your basically assets minus liabilities is equal to your net worth. What you own minus what you owe to other individuals is your equity, which is why you see some companies, they're worth millions of dollars and they have great brand recognition, but if they owe a lot of money to other individuals or companies, this means that the company isn't worth a lot of money. A good example is Toys R Us. Now, Toys R Us, before it went bankrupt, had great brand recognition, a lot of customers, a lot of sales and assets, but they also owed a lot of money, especially the US branch, to other companies, which meant that the company, their net worth was very low. So make sure you know how to use this equation. What you own minus what you owe is your net worth. Or you can rearrange it so that your assets are on one side, your left side, and the right side is all of your liabilities and also what your net worth is of the business. So let's start with your assets. Now your assets are things of value that you own, such as your car, your property, plant, and equipment, your vehicle, and you use these for the business. They're the result of some sort of previous purchase, and these are company-owned assets. So because you want to record how much you own, and these can be used to generate money for the business. So you're going to use your car maybe for deliveries. You need to maybe perhaps own some property. Maybe you own like a little building or a little shack and you use it to run the business. The property, your plant, and equipment are things that you own or the company owns for the business. Equipment is a big one. Oftentimes, maybe if you're in a factory, all of those machines are basically assets to the business. They have value and they're recorded at their cost. So if you buy a car for the business, maybe a delivery car, and it's worth $30,000, it shows up on the balance sheet as $30,000, basically the value of what you purchased it at. There are also some other assets such as the accounts receivable. So maybe you've sold a product or service to an individual or company, but they haven't paid you yet. That's money that's due to be received, and that would be an asset. Cash, accounts receivable, supplies, equipment, anything that you own is considered to be an asset. Okay, and then we have the liabilities. Liabilities are monies that you owe to other individuals or companies because you need to borrow money to buy things. A big example is a bank loan. In order to buy all that fancy equipment, those supplies, you need to borrow money because I'm not sure, but maybe you didn't know, but a lot of businesses have that starting capital by themselves raised from the shareholders. So perhaps you need to borrow some money, and bank loans, mortgages, these are considered to be liabilities, and you owe this money to other entities. Utility bills are also counted as accounts payable. And accounts payable are generally smaller bills that perhaps you buy on credit. You don't have the cash up front and you're going to pay them back later. A big example is restaurants. I don't think restaurants pay every time somebody delivers, fresh produce, because they probably get fresh produce delivered once or every couple or a few days. So it makes sense to tally up what's owed to them, and then at the end of the month, you just pay whatever's owing. Utility bills, accounts payable, these are all things that you owe because of a past transaction. So what you own minus what you owe is considered to be your equity. Now, equity can be broken down into a few accounts, as you'll see in the upcoming videos. The equity is the net value of the business, namely what you own minus what you owe to other people or businesses. Now, if you are doing some accounting, and one thing you'll realize is that accounting is different for a corporation versus a sole proprietorship. A sole proprietorship, you basically have one type of equity account, which is called capital. But for corporations, you're going to deal with retained earnings, but shares. If an individual or company invests in the business, perhaps they own some sort of ownership, and this is expressed as like a percentage of common shares or preferred shares. So shares are a percentage or a piece of the ownership, and it's reported in the equity section. You'll also get something called retained earnings, and retained earnings is basically the accumulation of all of the profits generated over the years. And when you have this pool of retained earnings, you can distribute that to the shareholders in the form of dividends. I'm going to make this little point over here. Accumulated profits to be distributed to shareholders. So every time your business incurs a profit and it's a corporation, at the end of the reporting period, all of that gets reported into a retained earnings. All of the revenues, expenses, and it gets lumped together into the retained earnings. So these are the two main accounts you'll see for a corporation in the shareholders' equity section. Now, when it comes to retained earnings and things that drive value for a business, we also have revenues and expenses, and perhaps you're more familiar with this. Revenues are monies that you make because you sold a product or service to a customer. If you were running a restaurant, every time you sold a plate of food or sold some beverages, or collected tips. That's all revenues for the business. And in order to make money, you have to calculate your profits. Your revenues minus your expenses equals your profit. Expenses are things that you spend money on for the business in order to make revenues. So utilities, rent, maintenance, advertising. In order to make money, you have to spend money sometimes, or most times in businesses. So your revenues minus your expenses is going to be your profits. Now I'm going to add the definition right here. All right, so the money that you make because you sold a product or service minus all the money you spent in order to incur to make those revenues, those are called expenses. And profits equal your revenues minus your expenses. And you also have one final activity. I'm see if I can add on to here. Your dividends. Dividends are not part of your profits, but their money is distributed to your shareholders or investors because you generated some profits. So let's say, for example, if you have some shares and maybe you want to distribute some of the earnings, based on the percentage of ownership, maybe you distribute 70% to whoever owns 70% of the shares, and then 30% of the profits to whoever owns 30% of the shares. It kind of works like a pie. If you own more of the pie, like 70% of the pie, you're entitled to more of those dividends. And the monies are distributed to the shareholders and investors are called dividends. So all of that accumulated profits, you can decide every year how much you want to distribute to the shareholders. There are actually some stocks that solely focus on as high as possible dividends, and this drives the value of the stock up. All right, so these are some basic definitions, and today I talked about the introduction to accounting, assets, liabilities, equities, and what comprises of the equity account. Assets and liabilities are pretty straightforward, but the equity section can get a little bit complicated. For financial accounting, you'll most likely deal with shares, or common shares or share capital, retained earnings, and retained earnings comprises of the revenues you make, the expenses, and then that all just gets lumped together into this account, minus whatever dividends you pay out to the investors. Okay, that was the first video. In the next video, I'm going to be teaching you about the debit credit theory and how to use T accounts. Thanks for watching, and I'll see you in the next video. All right, take care and bye-bye.